Welcome students, welcome to this presentation on an introduction to foreign exchange. In this presentation, you will see how the foreign exchange markets function, what are the activities that take place in a foreign exchange market, who are the participants in the foreign exchange market, and also how currencies are actually sold, bought and sold. To understand this foreign exchange market, it is necessary to know the origin of money. Who doesn't know what money is? Everybody knows what money is, but we have not gone on to understand the origin of of money or the evolution of money because that doesn't seem to be very important. But for a student of economics, it is important to know what is the origin of money and how has it evolved over time and what kind of difficulties did it pose, because of which we had to move into this foreign exchange market. Barter was the easiest form of trade. We know the earliest form of trade, and much of the ideas that we know about the evolution of money is historical, partly anthropological, and also imaginary. So the examples that we give are probably imaginary because we do not really know how trade must have taken place. But we understand that since there are remnants of barter even in the modern economy, we can understand what kind of difficulties must have been there during those times during taking a trade by barter. So it would be that one bag of potato is equal to one bag containing 100 potatoes must be equal to say 200 units of lime or something like that, in which case we would say that one bag of potato is equal to two bags of lime. Now that's called the direct exchange of goods for goods, and we can now understand what kind of difficulty people must have experienced when they had to directly exchange goods for goods. There could have been lack of double coincidence of one. A must have said that I have potatoes to spare, and B says that I have lemons to spare. But the potato man says, I don't need lemon, I need something, I need rice. Only then I will give away potato. And the lemon man would say, I would not give away lemon for potato, I need lemon for vegetables, and so on and so forth. So we can multiply those examples and think of it. But the idea is that barter started posing a lot of problem. How do we save perishable commodities? For example, if the farmer has milk, how does he become wealthy? The milk would get spoiled by evening. So perishable commodities had difficulties. Then carrying commodities from one place to the other, having animals. Then how could animals be traded? Or there would be difficulty for services. For example, how does this boatman offer his service of crossing the river? He has to wait for a passenger who would give exactly what he wants. Only then he can take the passenger across the river, and we could complicate more and more of these scenes. So eventually, people trading decided that there is a need for something by which they will be able to account the commodities that they are trading with each other. And in its history, we know that there have been commodities which have been used as money. For example, animal skin and stones and salt was used as money. Then we have various kinds of even animals were used as money, is what we read about. Now any of these things would have been there, but then we know the difficulties of this. Slowly we see that there has been a movement, evolution from commodity money to metallic money. Once possibly people discovered that metal was more stable than any of these commodities, they started using metallic money. This metallic money stage also went through several changes, because gold, silver, iron, and all of these metals were used as money at one time or the other. Iron, of course, did not meet the criterion of money even at that time, because it was abundantly available and had to be carried in large amounts. And gold was having a problem that it was very small. To carry out very small transactions, you'll have to get speck of gold. So there were problems of these kind of metals, and thus we have metals of lesser value in between, like copper and bronze and aluminum, which were used. Aluminum came in much later. So these kind of currency, these kind of coins were also used as money. then we see that as the trade expanded, it was not possible to expand the amount of gold we have. Moreover, gold was posing problems of moving from one place to the other, with the problem of theft and carrying the dangers of carrying gold from one place to the other. So it was decided probably that there is no need to carry all the gold from one place to the other. Instead of that, paper currency came into being. Paper currency came around 900 AD and in China with the printing press. And with that, what happened was the gold was not moving from one place to the other. Instead, there was what was called as representative paper money. This representative paper money was held by traders, and this could be exchanged for gold in the other place. So gold was used by covering it with representative paper money. Then this it was soon discovered that there is no need for so much of gold for carrying on transaction, and gold was not able. It was not possible to increase the quantity of gold as was the increase in the trade. So slowly, this representative paper money, where the paper money could be converted into gold, that gave place to inconvertible paper money, where the paper money cannot be exchanged for gold. Now this kind of changes takes place, but one of the big problem that they were trying to solve was that there should be a common unit of value. That means there should be something in between by which we can measure the value of one commodity vis-a-vis the other commodity. That means a bag of 100 potatoes should cost 100 rupees, and a bag of lemon of 200 rupees should 200 lemon or 300 lemon also should cost 100 rupees or something like that. So the idea was that we were able to bring down the value of potato and lemon to a common number, and that happens to be by explaining it in terms of money. So money acted as a measure of value. And the other big activity of the function of money is that money should be acceptable both to the buyer and seller. Those who lived in the seaside had seashells, and those who lived by the forest had animal skin. Now they could not have traded with each other because these two were geographically different locations, and these commodities were not accepted. So anything that had to be acted as money should be accepted by both the seller and the buyer. Thus came this idea of domestic currency. Now, the question is a little different. When I want to enter into foreign exchange, the question is a little different. In the case of trade between boundaries, what happens? The principles of trade within the country and boundary is the same. There's nothing there. One has to sell and one has to buy. But once we are trading across the boundary, we get into a difficult position, because the currency we have with us, with which we want to buy something, is not acceptable as a medium of exchange in their country. So they are not willing to purchase, they are not willing to sell us something with accepting our currency. Similarly, we are not willing to sell our commodity to another country and accept their currency. So this gives rise to this problem of the medium of exchange function of money, which is not satisfied once trade takes place between two countries. And that is where this currency, domestic currency, is not accepted in the other country. So gold was accepted, but currency was not accepted between the trading partners. So once the current domestic currency was not accepted by the other country, comes this issue of foreign currency. Each country would treat the currency of another country as foreign currency. What is this foreign exchange and foreign exchange market? Paul Enzig said it is a process of converting one national currency into another and transferring it from one country to the other. That means the currency from our country has to be transferred into the currency of the other country. Now, how do we do that? How can the currency of one country get converted into the currency of another country? So foreign exchange market comes into the being, and in this foreign exchange market, essentially individuals, firms, banks, they all participate in that market, and they buy and sell foreign currencies. So foreign currencies are treated like a commodity, and it has got a price, and that is what is exchanged in this foreign exchange market. Now, foreign exchange markets, we need to understand how are payments made in this for this foreign trade. Foreign exchange markets. There is a global marketplace for all of these trades to take place, and it is not a geographical place like a vegetable market where we can go and buy vegetables. It's a global marketplace. It is an internet connected marketplace, and there's no specific location, but there are different methods of payment. Payments could be made by bank transfers, it could be made by checks, it could be made by drafts, it could be made by a foreign bill of exchange. Now let's look at the major financial centers of the foreign exchange market and how do they operate. It is very interesting. It's a very unique market because this market functions on the basis of the different time zones in different parts of the world. One market ends and the second market begins. That market ends, the third market begins. So the all the foreign exchange markets across the world are connected to each other for all the 24 hours. That means, let's take this example here. The regular business day ends in San Francisco and Los Angeles. By the time the market ends in San Francisco and Los Angeles, we will find that the market has started on the eastern side. We have Singapore, Hong Kong, Sydney, and Tokyo markets begin. And when Tokyo markets have they're almost finishing the day, we have the new market emerging that time. The business will start for London, Paris, Zurich, Frankfurt, and Milan. When that market is almost ending the day, you'll find that New York and Chicago markets are open. So all these markets, these are all important financial markets of the world, and all these financial markets operate because of the different time zone. The markets, financial exchange market is operating all 24 hours of the day. Now, all these markets are connected electronically, they are in constant contact with each other, and they form a single international foreign exchange market. So, the biggest geographical trading center is in United Kingdom, primarily in London. Now, how does this market function? As I just told you, time zone keeps all these foreign exchange markets connected with each other, and they are open 24 hours a day because when the market in England, London stops, the market in the next country begins, and that's where all the markets are connected to each other. They work 5 days a week across these major financial foreign exchange markets across the world. They are extremely active at any time, with the price code changing every minute. If you look at every second, actually, the price code of one currency in terms of the other currency is changing. You must watch how the currency rates are changing every minute of every second of the time you're watching the screen. You'll find that the exchange rates are changing. It's a highly fluctuating market, and this market is shrouded with uncertainty. It's ever changing and leading to everlasting opportunities for forex traders. So this forex trading is like participants, brokers in the in the stock market. There is a large opportunity for people to participate in the foreign exchange market as brokers. So that is like this market where people who have the risk appetite, people who know economics or accounting and business studies, and of course people who have a way of understanding business. But you need to know some conceptual background of this market, technical knowledge about the market, and that is how this foreign exchange market provides large employment opportunities also for those who are willing to take risk in this market. Now let us see how this foreign exchange trading actually takes place. Now, in a foreign exchange market, what happens is there are two activities happening. One is buying and one is selling of currency. So, a currency is bought and a currency is sold, but there is no commodity in between. Only currencies are bought and sold. Now, that means if we want to get a dollar, if we want to buy a dollar, we cannot buy a dollar by dollar. We will have to buy a dollar by offering rupees. So we have to sell rupees, and by selling rupees, we will have to buy a dollar. We will have to give away rupees and then get the dollar. So that is how it needs to be bought with, each currency has to be bought with the help of some other currency. This market has got very few barriers to entry, very low barriers to entry, except that the person should have deep pockets and lot of money to invest in this market, and being very alert to seeing how this market actually functions. It has got very high liquidity. As let's look at how the currencies are bought and sold. The currencies are bought and sold only in pairs, which means if we want to get a dollar, then immediately the dollar is purchased by giving away rupees. So the sale of currency and the purchase of currency has to happen at the same time. So all these currencies are listed in pair, USD base and CAD code. That means US dollar is the base currency, and the value of US dollar is explained in terms of the Canadian dollar. So when we are explaining the US dollar in terms of Canadian dollar, $1 is equal to so many units of Canadian dollar, then we call it as a base currency USA, and the Canadian currency as the code. Indian currency with any other established currency is called an exotic currency pair, simply because countries like India, which are developing economies, when we pair up with any developed country, it is known as an exotic pair. And of the currencies that are traded in the world, the Euro USD is the most traded currency pair in the world. The daily trading volume of foreign exchange market is extremely huge, and it's a very liquid asset, most liquid assets that are traded in this market. And any economic news from any part of the world, any policy decision, any political decision, or anything, that a war or a flood or a cyclone or any of these things are enough to bring disturbance to this market. So it is transmitted immediately into this foreign exchange market, and these foreign exchange markets can now be operated from home of these brokers because of the interconnectedness through the internet. Otherwise, it used to have times by which the markets used to work. Today, it works almost all the hours. So a person can operate in Hong Kong market, then work in the London market according to the time by sitting at home. So it's a highly volatile market as well. Now look at the currency here. The US currency is called the dollar. US dollar is called as a vehicle currency. Now what is a vehicle currency? Most currency values are expressed in terms of dollar. So this dollar, why has this dollar become so important? Dollar is accepted as a unit of account. It is accepted as a medium of exchange. It also acts as a store of value. All the money functions are also performed by the US dollar, and it is also used by private and official international transactions are also done in dollars. Now, why has dollar become so important? We give the reason that the dollar value is far more stable. It has got a well-developed financial market, and also its economy is a very large one. So, based on these factors and that how it has performed in all these years, it has continued to remain as a vehicle currency, though there are disturbances in that vehicle currency status in the recent times. Now, there is the Bank for International Settlement at Basel in Switzerland, and they estimate what is the total volume of foreign exchange trading that has taken place across these couple of years. Now, you can see in 2019, the volume of foreign exchange traded per day is 6.6 trillion. This was 4 trillion in 2010. So we can see how in 9 years' time, from 4 trillion per day trading, it has increased to 6.6 trillion trading in 2019. This is because the volume of international trade has also increased, and once the volume of international trade increases, the amount of currencies that are needed to make payment and receive for trade also increases. Now, let's look at the participants at this foreign exchange market. There is at the base level, the first level or the bottom level, what we say, the simple participant who are traditional users of foreign exchange. It could be students who have to go abroad to study. There are tourists who have to go to some other country, and therefore they need the currency of that other country, or it could be an importer of somebody of some commodity who has to make the payments to another country, or it could be an exporter who has to get payment for the goods that he exported, or an investor of some kind in some other country, then also he will need foreign exchange. So these are not traditionally, these are not people who are into regular business. They need foreign exchange only as and when they enter into business. So buy it only for the regular use, for the use, and they buy it from commercial banks. The second participant and the major participant in the foreign exchange markets are these commercial banks, and they are responsible for the interbank market operations. Now, what do? They act as a clearing bank between the users and earners of foreign exchange. Who is a user of foreign exchange? If we have to buy some commodity, some machinery from outside, then we are the users of foreign exchange. And then if we have exported some commodity, some things outside, we are the earners of foreign exchange. So the users and earners of foreign exchange, they get cleared through this commercial bank. Commercial bank also provides a bill, the foreign exchange. They sell foreign exchange bills of exchange. They discount the bills of exchange brought to them. They issue bank drafts. They effect telegraphic transfers, and they also provide other kinds of credit instruments. They are the biggest participants, and they deal with the largest volume of currency internationally. Now, Citibank or RBS. Then the third one are these foreign exchange brokers. These are people who take foreign exchange market as an occupation. They engage themselves through this by getting employed in this foreign exchange activity. Now, what do? They are not actually dealer. They are not people who are buying and selling any commodity. They are participants in such a way that they track the inflow of currency, and they also see the outflow of currency between the users. And what they do is they act as a middleman between the buyer of a currency and the seller of a currency. So they have information of the market, the rates, the quotes, and if somebody needs currency, they need a particular currency, they would buy it from this broker. If somebody wants to sell a currency, they would sell it to this broker. So this broker does not actually deal with currency, except that he helps his clients who wants to buy or to sell, and he would buy it at the best price. He would help the client obtain the buying at the lowest price and sell it at the highest price. That is what this broker the foreign exchange broker does in this particular market. They are a major source of market information, and they trade across the market according to the client's need, and of course they charge a commission from the clients for their services. Then we have the central bank. Central bank is the lender of the last resort and the custodian of foreign exchange. We are aware of that function of the central bank. So this central bank observes the or monitors the imports and export, or the balance of payments of the country. So if there is a disequilibrium in the balance of payment, which is indicating to something more dangerous happening, the central bank will come in the picture, and it would buy and sell currency, so that this currency value may not fall very low, or the currency value may not rise too high. The central banks of the world, they participate in the foreign exchange market to bring in orderliness in the market, and it buys and sell currency to smooth out the disturbance that can happen for any currency. Now, what are the functions of a foreign exchange, of this foreign exchange market? First one is the transfer function, transferring purchasing power from one country to the other. So if the importer has to make payment, say in dollars, then the conversion of the rupee to the dollar will be facilitated in this foreign exchange market. So this transfer function is performed through the use of credit instruments, bank draft or bill of exchange or telephonic transfers or whatever. And with telephonic transfers today, foreign exchange markets are truly global. Currency transactions today require just a few seconds for a deal to be completed. Let's look at the second important function of the foreign exchange market. It provides credit to the importers of goods from one from another country. For example, if an importer desires to purchase some foreign machinery from another country and can make the payment only after 90 days, then this by paying a bill of by signing a bill of exchange, then this foreign exchange market would accept that, essentially to facilitate this trade between that exporter of that machinery and the importer of the machinery, and the payment would be settled in about 90 days time or 3 months time. Is the hedging operation. Now, this market has got a very high risk involved in its transactions. Now, to avoid the risk involved in the transaction, because every minute the value of the foreign exchange values are changing. So, if some quote has been made, and in the meantime, if some news, political news, or some natural disaster or something happened, then the foreign exchange rates will tumble. So to avoid the risk and therefore lose out because of these kind of risks, there are ways in which the participants in the foreign exchange overcome this risk. That is called as hedging operations. Now, these hedging operation means buying and selling either at a spot rate or at a forward rate. Now, for example, here, when we talk about the type of transactions happening in the Forex market, the first one is called the spot rate. Spot rate would mean that the importer and the exporter agree to close the deal at this given moment of time, at this given rate, and then the deal is closed and the payment will be settled in 2 days time. So the rate at which the current rate at which the two parties have agreed to make the deal is called as a spot rate, or it's called a spot exchange rate. This spot exchange rate is again very volatile, because it can, if it was 5 minutes ago, the person would have made a lot of money or may undergo very huge loss if we didn't wait for a little longer. So these kind of risks that are involved are so close to each other that participants in the market would like to safeguard themselves. So either take it in the spot rate or going for the forward rate. Now, in the case of forward rate, what happens is the buyer and seller agree to a certain foreign rate of exchange to be paid after 90 days. So that rate can be the rate, either they fix it at today's rate, or they can decide to fix the rate after 90 days. So in either of the cases, after 90 days, whatever is the rate that they have fixed, that rate they have to pay. So there is no risk involved, but at the same time, if one loses on that day, then that is a loss. But this uncertainty in the market can be avoided. So either they deal to close the transaction on today's rate and then pay it on today on a future date, or they decide to pay on that future date's rate of exchange that will arise then. So that is called as a forward rate. So money is exchanged on the date of maturity, and the rate settled is called as a foreign exchange rate. Now, there is another activity that happens in the foreign exchange market called the buying and selling of currencies and the arbitrage. Now, there are brokers and participants in this market who may be willing to buy it in one market when the prices are the value of the currency is low, and simultaneously sell the currency in another market where the currency value is high. The same dollar will have a value in market A, and it might be low in market A. So the dollar will be purchased in this market with whatever currency, and simultaneously the market it will be sold in the next market or where the dollar value is high. So between the two markets, there is a small window, and through that window, the profit is made because of the differences in the value of the exchange value of currency in the market A from that of market B. So the purpose is to capitalize on the exchange rate differentials between the two markets. So this involves foreign exchange market from the market with a lower exchange rate and move it to a market where the exchange rate is higher. So this is just buying and selling of currency between two markets with an intent of making money. Now, in this particular video, I have introduced to you a little bit of what happens really in the foreign exchange market, what are the different counters of foreign exchange market. But in the next presentation, we shall look into how the exchange rate itself is determined from an economic students' point of view. So I hope you have found this presentation useful. Kindly share this video with your friends who are also studying economics or need to understand concepts in economics. Click the like button, share it with your friends, and also please subscribe to this channel if you haven't yet subscribed to the channel. So thank you very much.